Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. This week we're going to be talking about the market and taxes, two really exciting, complicated topics. First, we want to go through the market. We have had just a tremendous run over the last 2 months. We've actually only had 4 down days in the past 2 months. That's actually a record. It's unheard of. They've not been large up days, 200-point, 300-point up days, just little melts up without a whole lot of volatility. 25 points one day, 20 points the next day, 35 points the next day. But the market just continues to melt up without much volatility, very different from what we saw back at the end of 2011. So as a result of this melt up, we're starting to hear a lot of calls for a reversal. But there's so much money on the sidelines that as the market continues to melt up, that money on the sidelines just keeps wanting to get back into the market. And so even though intraday you'll see the market go down sometimes 80, 100 points, that money will start flowing back into the market and will still end up on a positive. So it's very interesting to watch intraday, how the market is moving, and watch as we just continue to melt up, driven largely by a lot of the money that's on the sidelines, but also by some positive economic indicators such as improving unemployment, improving confidence levels, etc. So a lot of that stuff is what's moving the market. However, it's sort of a complicated market that we're seeing right now, and that's one of the reasons why a lot of the money managers are calling for a reversal, because a lot of the other indicators that typically confirm a positive move in the market are really not confirming this rally, and that's confusing a lot of people. So I'd like to talk through a few of those other indicators that we're usually looking for that usually confirm this type of a rally in the market and would cause us as money managers to believe that the market is going to continue to rally. These factors are sort of conflicting, with the overall rally that we're seeing in the market. So the first thing that we're seeing that doesn't really confirm this rally is volume. We're seeing really, really low trading volume, really low volatility. Typically, what you're going to see with an increasing market is high volume, a lot of trading, a lot of money being driven into the markets, and high volumes. That's really not happening here. We're actually seeing really historically low volume in trading in everything from large caps to small caps to international names. So that's sort of a conflicting factor that's not confirming this rally. The second thing that we're seeing is that usually we have the Dow Transportation Index, and that's an index that tracks airlines, UPS, FedEx, CSX, people that move objects. The Transportation Index, usually we see that with improved markets, the Transportation Index is also improving. That's not something that we're seeing here. The reason that we usually see that is because if the economy is strong, people are going to be moving things. They're going to be putting them on railroads. They're going to be putting them in planes, trains, and automobiles and moving them across the country. That's really not happening here. So the Transportation Index is really not confirming this rally that we're seeing in the markets. Now, one thing that could also explain that is that oil prices have increased. And if oil prices are increased, their cost of doing business is increasing. So that's something that may not necessarily be confirming or may not necessarily be driving that trend, but it's something that we watch the Dow Transports to see what's happening there. And third, and most notably, is Treasuries. And I know that I've harped on this for the last several weeks, but usually in an improving economy, in an improving market, people start to get concerned about inflation. When you get concerned about inflation, you see interest rates start to rise, just by default, regardless of the fact that the Fed is trying to keep interest rates very, very low, artificially low. You'll see interest rates rise just simply by because of fears of inflation. That's not happening here. Even as the market has continued to improve, we're still seeing interest rates getting driven down because a lot of money is still just driving right into Treasury markets. So we're seeing bond prices increase and bond yields fall because that's still the safety trade. So it's somewhat disconcerting to see that as we're having this very strong melt up in equity markets, it's really not being confirmed by Treasuries. What we're actually seeing is more money going into Treasuries right now and interest rates being driven even lower. So that's really not confirming what we're seeing in the market. And lastly, of course, we're looking at the euro versus the dollar. Our expectation coming into 2012, of course, was that the euro was going to continue to decline. European ECB was starting to print money. Typically, we were going to assume that the euro would continue to decline, but it's done nothing but gain. As a result of that, of course, the dollar has continued to weaken, and that's something that we're watching going forward as well, because commodities have continued to soar, and we're watching the impact of that on the markets as well. So we have have lots of conflicting factors that we're seeing in the market right now. So we're having a really strong rally. It's continued throughout 2012, but a lot of the talking heads are still calling for a sell-off, and largely because of the reasons that we just reviewed. One is low volume. Two, interest rates continue to be driven down. Three, Dow transports aren't confirming this rally. And third is we're looking at the concerns over commodity prices, oil prices continuing to rise. You know, and you have to also look at the fact that we have increased U.S. debt levels. This is a presidential election year. Continued high unemployment, even though that's continued to decline or has declined slightly, it's still historically very high. So there's still a lot of concern in the air, a lot of friction in the air that really undermines or could undermine this rally. So I'm not trying to be a naysayer, but this is a very complicated market. It's not what we typically see with strong growth in the market. And that's why a lot of analysts and economists are calling for a decline. But regardless, the market does continue to melt up. Volatility remains very, very low. It's baffling to a lot of investors and a lot of money managers. But that's what's going on today. So hopefully that was a reasonable explanation of the pros and the cons that we're seeing in the market this week. There's so much going on that I'm sure that if you're watching this, the week of March the 3rd or 4th, that it could have changed. But that's what's going on in the markets today. We're writing new textbooks on finance and economics, it seems, in this really complicated market. So that's what's going on today with the market. We'll be back in just a minute to discuss another very complicated issue, taxes, which are expected to change coming into 2013. We want to talk about that and what it's going to mean to you. So please join us in just a minute. We'll be right back. This is Money Matters.
Hello, this is David Kroll from Mortgage Network for the Mortgage Minute. And about every 10th show, I tell you the same piece of advice, which is you need a plan. Every single one of us needs a plan. We live in a chaotic world. This is an election year. Greece is doing great today. Tomorrow it may be in the tank again. Your personal finances are up and down all around. Each of us needs a plan of attack. That's what professionals in the mortgage industry can do for you. That's what professionals and financial advisors can do for you. You just have to pick somebody, sit down, and come up with a 2-year, 3-year plan. Interest rates are going to remain extremely low for the next 2.5 years. We do know that. There are a few things that we actually know. There are many more that we don't. So get your plan together. Thanks.
Welcome back to Money Matters. The second segment, I'd like to talk about taxes. It's a complicated topic, but it's one that impacts everybody, and I think is going to continue to gain in its traction throughout the year as we hear more and more throughout this presidential election about taxes, about spending, about our debt, etc. So we're going to hear more and more. So it's a well-known fact that the Bush tax cuts are going to sunset at the end of this year, at the end of 2012, which is going to cause tax rates to increase for most Americans, unless, of course, Congress does something between now and then. In addition to that, we're also going to have several new taxes that are embedded inside Obama's health care bill that will take place, or that will also take effect in 2013, unless, of course, something happens. And we're also hearing a lot of whispers, and those whispers are getting louder about some additional proposed tax increases that we might start seeing more and more of throughout this year. So I want to talk briefly about what each of these tax changes is, and also how you can begin planning now in 2012 to minimize your overall tax exposure going into 2013. So first, let's talk about the sunset. So the Bush taxes, the Bush tax reductions are going to sunset at the end of this year. First, that's, of course, the marginal tax rate is going to increase from 35% to 39.6%. So that's obviously a significant increase. Second, the tax on qualified dividends, and those are dividends on stocks that you've held for greater than 60 days. That's what qualified dividends is going to increase from 15% to your ordinary income tax level. So if you pay more than 15% in taxes right now, then your investment income is soon to be taxed at a significantly higher level. And third, long-term capital gains, which are gains on assets that you've held for greater than 1 year, is going to increase to 20% from the current 15%. Or if you happen to be in the bottom two tax brackets, the 10 or 15% tax bracket, it's currently 0%. So that's a significant increase there. The next thing that we want to look at is the tax increases that are going to come as a result of the Obama health care bill. So the first thing that we need to talk about there is this Medicare payroll tax of an additional 0.9% for those who earn over $200,000 if they file single, or $250,000 if they file as married. The second new tax is going to be a 3.8% Medicare tax, a Medicare contribution tax on all unearned income for high-income taxpayers. And that definition is the same as it was before. So basically, this is an extra tax on investment income, on gains of sales of investment property, investment real estate, etc. So you've probably been hearing about that 3.8 tax, and that's something that I think is going to impact a lot of people's actions when it comes to the market. Third, we're going to see an increase in the floor for itemized medical deductions. So what that, from 7.5% to 10%. So what that means is that you can only deduct expenses, medical expenses, if they exceed 10% of your adjusted gross income. So if you make $100,000 a year, you would have to have medical expenses that exceed $10,000 to be able to deduct whatever that marginal amount is. That's going to be an increase in that floor. And then lastly, and this is a big one, right now federal estate taxes are expected to revert back to 55% from their current 35%, where they've been now for several years. They also expect that the exclusion on estates, which means the amount that you can exclude from taxation, is going to be reduced to $1 million from the current $5 million. So if you have an estate that's valued at $1 million or less, this is not going to be impacting you. But if you have an estate that's valued at more than $1 million, and this includes everything from your home to your investments to everything that's in your name, or in a trust in your name, etc., everything over that $1 million is going to be taxed at 55% beginning in 2013, unless Congress does something. So these are some things that we're obviously concerned about, that we're looking at how we can plan. Some additional potential increases that are based on previous legislative efforts that we see, or that we have seen in the past, and that we're just a little bit concerned about, are limits on overall deductions, perhaps even higher tax rates on high wage earners, as we've been hearing, of course, from Warren Buffett, his famous sound bites, and additional estate planning restrictions. So in general, those are some things that we're watching out for. So what can you do? If you realize that you're going to be subject to increased taxes in the future, how can you reduce your overall exposure? And it's dangerous when you're talking about taxes, because everybody's situation is different, and so you can't talk about each of these strategies in a vacuum, but you really need to look at your own personal situation, talk to your tax advisor, talk to your financial planner, and see if these recommendations work for you. So that's sort of my disclaimer before I get into what some of the steps are that you can do to prepare yourself or to minimize your overall tax bill. First, if you anticipate that you're going to be in a higher income tax bracket next year, one thing that you might want to do, if you can do it, is accelerate income into 2012. So of course, for self-employed individuals who accept receipts, etc., they might be able to bring their income into 2012. But really more importantly, if you currently take required minimum distributions from your IRA or Roth, just from your IRA, your traditional IRA, you might want to consider taking higher distributions in 2012 if you think that you're going to be subject to higher taxes in 2013. You also might want to start taking withdrawals from your deferred annuities. If you've let those deferred annuities grow year over year over year, you're going to have to pay taxes on that growth at the time that you take income from those annuities. So you might want to consider starting to take that in 2012, or take a larger portion in 2012, perhaps even roll them in 2012 as opposed to 2013, so that you can pay that reduced tax. Now, of course, you have to balance the timing of these moves with whether or not it makes economic sense for you, what your cash flows look like, etc. But those might be some small strategies that you could take in 2012 to help reduce your overall income tax bill. Second, because of the expected increase in long-term capital gains rates, if you anticipate selling an asset, whether it's stock or other securities, investment real estate, etc., you might want to consider selling it in 2012 before those rates go up to 20 or possibly even 28%. Currently they're at 15%. For lower tax brackets, they're at 0%. So that's a huge increase. One big unknown here to consider, though, is if you want to sell in 2012, what price are you going to be selling at? If you expect that your gains are going to be substantial going in, if you wait until 2013, let's say we're talking about investment real estate, and you expect that real estate is going to bounce in 2012 and be substantially higher in 2013, would it make more sense for you to wait until 2013? Would the gain in the asset and the appreciation in the asset outweigh that increased tax? So something to think about there. Certainly it might make sense if you don't think that the asset is going to grow significantly over the next year, but if you're expecting that it will grow, something to consider. So again, talk to your tax advisor, talk to your financial planner, etc. And then the third, there's lots of estate planning options that are available as well. This is really a topic that is so broad that we need to bring an estate planning attorney in here to talk about it on another show for sure. But one very basic one is if you expect that your estate is going to exceed the exclusion, and it makes economic sense for you in the sense that you actually have enough cash to be able to do this, you might want to start reducing the size of your estate by gifting. This year, you can actually gift $13,000 tax-free to anybody that you want to. If you're married and you file jointly, you can double that and gift split it and give $26,000 tax-free to your children, to your grandchildren, to your next-door neighbor, whoever you want to. In doing that, you're going to reduce your overall estate so that if you happen to pass away, it will not be taxed at 55% if your estate exceeds that $1 million. So that's a positive. The other thing that you can think about doing is the assets that you gift, they might be income producing assets, and you might want to gift those assets to lower income individuals. So if you know that your tax bracket is about to increase regardless of the estate tax, then you might want to gift income producing assets to lower income tax generating individuals, such as your children, your grandchildren. And again, you want to talk to your tax advisor about this because there are nuances in this rule, but kiddie tax, etc. But that might be something that you consider doing, such as dividend yielding stocks, interest-bearing investments, that type of thing. You might want to be looking to gift that to lower income tax individuals. So those are our strategies. They're very simplistic strategies, I realize, and they're not right for everybody. You have to really consider whether it makes economic sense given your cash flow situation. But those are just some things that you might think about doing this year in the event that these tax changes do take place in 2013, that changes are not made, which who knows what's going to happen with that over the rest of the year, but these are some reasonable planning tips that you might take into consideration. So that's pretty much our discussion on taxes. We'll be back in just a moment with our closing shots to discuss a few actionable items that you might want to, or a few action items that you might want to make this week. Thanks very much. We'll be right back. Welcome back to Money Matters. I have two basic parting shots today, one that relates to the market and the other that relates to taxes and the market. So first and foremost, because we're concerned that we might actually see a reversal, now is a great time to be hedging your portfolio by looking at volatility. You can buy volatility to hedge your portfolio. You can buy it using ETFs. Now is probably a great time to do that. It's really, really cheap. The VIX, which is, as we've talked about, the fear index, the volatility index, is very, very low relative to where it's been over the last few years. Now would be a great time to buy some volatility, to hedge your portfolio in the event that we do start to see a reversal in this rally that we've seen. Because if that happens, we'll probably see volatility increase, and you'll be able to gain from that. So that's parting shot number one as it relates to the market and what we were talking about with this rally. Number two is something to think about when it relates to taxes. If you're concerned, or if you believe that the tax rate on qualified dividends is going to go up to ordinary income tax levels from 15% where it currently is, you have to think about what the impact is going to be on large, high dividend yielding stocks. So, your blue chip, high dividend yielding stocks, those have been an absolute winner over the last several months. One of the reasons they've been a winner is because interest rates are so low, a lot of money is being driven into high dividend yielding stocks for yield. If you believe that the taxes on those dividends are going to go up, you might see money starting to flow away from high dividend yielding stocks. So if blue chip and high dividend yielding stocks, value stocks, represent a huge portion of your portfolio, you might want to consider paring that back little over little, or little by little, over the next year or so until we get to 2013, watching what happens with taxes, because there could potentially be a pullback in those stocks as a result of this increase in qualified dividends. So really something to consider, both tax-wise and also market-wise. So those are my 2 parting shots for this week. Hopefully they're helpful. Really look forward to seeing you again next week. Please send us any ideas that you have for future shows. We're constantly a work in progress and really value your ideas. It's made our show better, hopefully, over the past several months, and really love your feedback. Check us out on Facebook. Send me an email anytime. Love your feedback, love your ideas. So look forward to seeing you again next week. This is Money Matters. I'm Emily Johnson, and have a great week.